Hi, this is Dr. Charlie Peterson. I'm the author of Dude, Where's My Profit? The Accounting Finally Makes Sense mini course. Today I want to talk about journalizing. Journalizing is how we enter the numbers into a form prior to putting the numbers into the T accounts. It's called, when you transfer the numbers, it's called posting. So I have a journal form here. This can be purchased at Staples or Office Max. You buy them in a pad, and you'll notice it has a series of columns. Well, this column here is for the date. This is for the account. This is for your debit. I'm going to abbreviate it, debit or left, DR, and credit or right, CR. Okay, so this is your journal. Now, in order to journalize, you really have to understand how to put the numbers into the T accounts. This is covered on other videotapes, so I will assume that you have mastered the ability to transfer the numbers from the transaction page into the T accounts directly. Remember, we call this posting. Now, I'm just going to show you an alternative way to record these transactions in the journal. Now, a journal is very important because a lot of education in accounting as you go up relies on journal entries, and very quickly you will see that there's a clear connection between the journal and the ledger by the way we are going to be recording these transactions. Now, I'm going to be reading the transactions because there's not enough room on the screen in order to show them at the same time. So let's start out with transaction number 1. I'm going to assume it's April 1st, and I've numbered my transactions 1 through 8, so I'll just use 1 through 8 as the date. Now, the first transaction reads, you invest $400 cash into your business. All right, well, as you know, the business cash increases as well as your investment. So what we're going to do then is ask the question, what account received the entry on the debit side? Well, clearly it's cash, so we're going to write cash right here. And then we're going to go over to the debit column, and we're going to write $400. Then you ask the question, what account received the entry on the credit side? And it was capital invested. So now, in order to distinguish between debit and credit here, we're just going to indent, just a little, don't too far. I'm just going to put a few dots down here to remind you how to indent. And we're going to write capital invested. And we're going to go over to the credit column and write $400. So the journal now for this transaction is complete. Now, suppose you were given a journal form with a series of transactions and a blank ledger. Could you post the numbers? Well, it's very simple to do. Here, this is their debit column. We would debit cash for $400. We would credit capital invested for $400. So you can see the relationship between the journal and the ledger. All right, let's try another one now. It's important to skip a space so all of these will kind of stand out without running in together. So it's April 2nd here. We'll do our second transaction. And it says earn service revenue for cash, $600. So if you're a painting company and you go and paint someone's living room and the job is all completed, they pay you $600. Now we need to record it in journal form. So again, the question, what account received the entry on the debit or the left side? It was cash. So you write cash right after the date line, and you go over here and you write, let's get the right line here, $600. Then you ask the question, what account received the entry on the credit or left side? Service revenue, $600. So let's write, again, we're going to line this up on the margin. Service revenue. Okay to abbreviate. And we go over to the credit column and we write $600. And that's another transaction recorded. You're probably already catching on already. Let's try number 3. we go to the bank and we borrow $300 worth of cash. All right? What accounts are involved? Well, cash and notes payable. We give the bank a note for $300. All right? And now, what account received the entry on the debit side? Well, it was cash. See, it was cash here. And we're going to go over to the debit column and write $300. What account received the entry on the credit or right side? Note payable. So we go over to the credit column and we write $200 here. All right, now don't forget to skip a space. Number 4. We pay the rent, $450 cash. All right, now remember, when you pay an expense, the expense account increases. So the entry on the left side will appear in the rent expense account for $450. So go here and write $450. Rent expense $450. Go over to your debit column and write $450. And how did you pay for this? Well, the entry comes out of cash, so it's going to be a credit to cash. So you're going to go to your credit point here, write cash, and $450. See how in the first 3 transactions cash increased, all as a debit. Now cash decreased as a credit because it's got to match exactly what's taking place in the T accounts. Try another one here. Number 5. Purchase equipment, $350 worth of cash. Okay, so the equipment received the entry on the left or the debit side, so that's the first. That's going to go right in here, equipment. And the amount was $350. And it was paid for in cash. These are all cash transactions. So we're going to credit cash. We'll move over to your credit column here. Cash, $350. All right, let's do number 6 now. Place an ad and we pay $50 cash. What account received the entry on the debit side? It was ads expense, so we're going to go here to ads expense. And that was for $50, so we go to our 50 here. And we paid cash, so that's going to be a credit. So we go over here for $50. I'm sure you're probably getting it already. 7. Let's see, 7 is we pay $100 cash on the note to the bank. So we go back to the bank and we give the bank $100. All right, so we're going to decrease notes payable, which is by a debit. So note payable. Notes payable, and we pay back $100. So we're going to decrease notes payable because it's entered on the debit side. And we're going to credit cash because we're paying back the bank, and that's going to decrease for $100. All right, let's do the last one here. We purchase supplies for cash, $25. All right, we know that the account that receives the debit entry is the supplies, so let's get that over here. And of course, we're paying cash for these supplies. And that's for $25 here and $25 here. Now, if you had a blank ledger, if this ledger was completely empty of any numbers, and you went through here and posted, posting means to transfer the numbers from the journal to the ledger. The very first transaction, you would debit cash for $400. Here it is. And when that transaction is recorded what you're going to do, this is called a post reference column. It kind of reminds you that you put the number into the T account, and you would simply put a little check here to indicate that you've done that. Now your capital invested is credited, so you go to capital invested and credit and come back and make another check mark to indicate it's been posted. Then you run down to cash here. Cash is increasing by $600, all right? So there it goes, you posted it in there. Come back and make a check mark here to indicate it's been posted. And service revenue is a credit, so it's going to be here. Come back and make a check mark. So you see in the bigger picture, we now will be recording journal entries first and then posting to the ledger. It's all part of the process, of the accounting cycle process. We've just added this additional step now of creating journal entries. All right? Please check my website if you've got some questions or suggestions. And also, if you would kindly let your friends and colleagues know about this website if you feel that will help them. And thanks for viewing.